So the next panel, we're here to discuss the changing face of global business, prospects and challenges for the next 100 years. Now, we all know that 100 years is a long time, but I hope that at that time, some of you remember what we said today. Now, one word that came out almost every other minute from the first panel is the word global. Okay? Now, we know that companies are just born global today because each company is in a constant hunt for the planet's best valuable materials, the most brilliant talents, and most reliable suppliers. And with the new technology, you're never immune from global rivals. Now, as Jiang previously introduced, I'm currently the director of the Chazen Institute of Columbia Business School. Now, the Chazen Institute takes pride in its mission to help reshape the thinking and discourse on major global business issues by drawing on expertise of world-class faculty members as well as our access to world business leaders. So today, we invited this group of esteemed panelists with a very diverse representations in terms of both geographic locations as well as industries. They will provide us their own forward-looking views as what main challenges for the business will be in the coming century. Now, under this grand title, after some discussions with my panelists, we have decided to focus on the discussion on two key issues. Now, the first one is how technological changes, especially digital technologies, have upset the original business models and impact companies' bottom line and customer bases, and why some industries companies have been more successful than others in adapting with these disruptions. And the second one is a much discussed issue, even arised in the presidential campaign, is the challenge that connected to the long-term social goal of sustainable development and what appropriate measures business executives should take to trade off the near-term results and the long-term goals. So I will first invite each of the panelists to shed their own light on these issues and share with us their best life stories. And I will give them bio when it's his or her turn to go. Okay. Now, the first one is that, according to a recent Harvard Business Review, the media industry is ranked #1 industry among all that has been disrupted most by the digital technology. I still remember when I was in grad school, we were discussing whether DVDs will replace movie theaters. Okay. Now, today we have to ask ourselves which will replace which, and I will invite you to fill in the blanks, and that answer will change day by day. Okay. So we're very lucky and honored to have our first panelist, who's both a veteran and captain of the media industry. So Robert Bakish is the president and CEO of Viacom International Media Networks. In this role, which he assumed in January 2011, he is responsible for all Viacom Media Network operations outside the United States, delivering content to 630 million households in 162 countries and 33 languages. That's quite a global map. Previously, Mr. Bakish was president of MTV Networks and a partner at Booz Allen Hamilton in its media and entertainment practice. Mr. Bakish graduated from Columbia's School of Engineering and Applied Sciences and then holds an MBA degree from Columbia Business School, for which he is currently a member of the Board of Overseers. Ms. Bakish, why don't you share with us your life story?
Thank you for that most generous introduction. So a brief commentary on the intersection of globalization and technology with respect to the media business. And I think obviously the globe's a very big place, we all know that. And what we probably also know is that the media, this thing not working? What we probably also know is that the media business has long been impacted by technology. You heard a reference of DVD versus theatrical. You could go back before that and you could look at essentially the invention of broadcast television as providing an alternative to theatrical, then pay TV, or what you might think of as cable TV, providing initially what was viewed as better reception, but ultimately what became known as more choice to the consumer. Now, sitting here today, of course, we're facing the impact of digital, broadly speaking, on the media landscape. And it's fair to say that digital is impacting really virtually everything we do. You know, starting with the content we make, which continues to be overwhelmingly on, call it the long-form side, whether that's a half-hour episode, an hour episode, a 2-hour movie, what have you, but also these days includes short-form content that might be a couple minutes in length, snap-length content made popular by Snapchat that's even shorter than that, game content. All of it's the digital transition is affecting and making us evolve our content offerings. It's certainly changing the way marketing works, and that could be whether you're a buyer of marketing, whether you're an advertising agency, or whether you're an owner of media like we are, where we've gone to having largely one-way marketing to it being more of a two-way conversation, and us including recruiting various thought leaders and bloggers and the like to do, and fans of content to do marketing on our behalf through social media. It obviously affects things, how we're doing our back office. We need to know more about rights. We need to have more efficient systems and the like. But what it really is affecting the most is distribution. And obviously that's because digital technology not only puts the consumer more in control of what they're going to, let's use the word watch, but it also allows for new entrants to more easily, perhaps, enter the business. So a lot going on with respect to technology. And by the way, as we look at all this, it's very easy to talk about a global strategy and the globe, but the reality is you can have global themes, but you very quickly have to look at individual markets from a strategy perspective, and ultimately nothing happens on a global level. It all happens market by market. So local market fine-tuning of strategy and obviously execution is ultimately critical to your success. So when we look at across all the markets, I think it's fair to say that this technology change, I happen to look at it as glass half full. Why? Because it's done already a number of things. First, it has opened markets, and probably the best example of that is China, where if you looked at China pre-digital distribution, essentially the market was closed to non-Chinese companies. Now, we at Viacom were actually a minor exception to that in that we had landing rights or a license for a 24-hour network there in the form of MTV, but the reality was it had very limited distribution. Then one day, roughly 18 months ago, maybe a little longer at this point, we did a deal where with the stroke of a pen, 380 million people were given access to the Nickelodeon library on demand in Mandarin, who had never had access to it before. And we went on to do, you know, a dozen such deals. And now today, those consumers have access to content on demand when they want it in ways that they never had before. And it really has changed the market. Now we always worry about regulation and where it might go, but at the moment, the market is radically different. And that's a positive, not a negative. You also look at, from Viacom's perspective, at least the media networks were largely pay TV networks. And therefore, we benefited, but in many cases were limited by, the reach of pay television. Now in the United States, basically 85%, so you could think of most consumers have Comcast or Time Warner or DirecTV or one of these things. But the world outside the United States is very different. Average penetration across all countries is probably in the 40% ranges, and many big countries are well south of that. Japan, 20, 22%. Indonesia, under 10%. So you have the opportunity now to serve these homes different ways, and the principal disruptor or opportunity there is the mobile networks. And I was recently at Mobile World, I don't know, a month and a half ago, meeting with an Indonesian telecom operator who had 160 million subscribers. Now granted, most of those were prepaid subscribers, which means low ARPU, low-end subscribers, but that carrier was very interested in figuring out how can they get people, even at the low end, to consume more data, because that's ultimately what drives the mobile business model these days. And so this opportunity to penetrate mobile handsets, particularly on a 3G plus basis, is a very compelling one for a business which had largely been restricted in terms of total reach. And then there's sort of more consumer touch points, whether that's apps, as I said, games, or one of the things I believe in this interconnected, ADD, digitally infused world, there's actually increasingly no substitute to the real thing. And while the real thing, experiencing an event on the ground, maybe going to a recreation destination, is not exactly digital technology, in many cases it's enhanced by digital technology, and of course it's an important complement to what we do to support our brand and franchises, and yes, drive our business market by market by market. So in that regard, one of the things that's critical in this digital world is ownership of intellectual property. If you look around at networks in the United States, you'll see many networks that license a lot of product, i.e. rent a lot of product. That's not a great place to be in this digital world, because you need to be able to exploit properties in various different ways. Obviously, you need to have on-demand rights in addition to traditional linear rights. You might want to do a sort of theme park ride around it. Ownership of IP is a critical factor for success in this world, and it's something we're very focused on. Now, obviously, all this stuff is not easy. You know that, we know that. And one of the challenges in all this is we are a division of a publicly listed company, and so things like quarterly earnings matter a lot, particularly the current quarter. And so as we look at it, sometimes we don't have the flexibility we would ideally like to have to invest in newer businesses, which are maybe a little bit earlier on the revenue curve. But nonetheless, that's a balancing act we're very focused on. And sometimes we do that through things like unconsolidated joint ventures, which has led to great success for us in India. And sometimes we just do that by saying no to a lot of things so we can say yes to other things. And finally, I would say as we do all this, it's great to have a strategy. Ultimately, you need to execute. And to execute, you need people. And the labor market continues to be competitive, varies by country, but let's say it's competitive. And more important, you need to have people energized and excited to go do their job and figure out how they can do it better. And so in this world, we're also increasingly spending a lot of time figuring out how do we inspire people, how do we train people, how do we reward people. And the reward doesn't always mean economics. It might in some cases mean attribution. But we've got to keep people focused because, as I say to our team, I can say anything I want, and it might be very intelligent or it might be stupid, but the point of the matter is it's not going to get anything done. What's going to get things done are the people in Mumbai, in Tokyo, in Dubai, because ultimately they're the ones on the ground, they're the ones transmitting the feeds, they're the ones doing the deals with advertisers, they're the ones who might be posting accounts payable transactions. So the employee side of this digital world is also a critical component. At the end of the day, I think the opportunities are very significant, as I mentioned, a couple of examples, and we're focused on, charting our way through any challenges to ultimately deliver growth in this complex world.
Thank you, Bob. So on the same article that I just mentioned, financial services ranked the third among all industries that's most disrupted by the digital technology. So today, we will have the next two experts from this domain. So we'll start with Ms. Ann Kaplan, who's the founding partner of Circle Wealth Management. So many years ago, I read in the Forbes magazine on how Ann Kaplan, along with 11 other women, half of whom were Goldman Sachs colleagues, formed Circle Financial Group that allows each member to control her own portfolio while also benefiting from the advice of other group members and outside experts. That was a very innovative peer-to-peer wealth management group that was in 2002, way before peer-to-peer became a buzzword. So I'm very honored to have the opportunity to work with Ms. Kaplan today on this panel. So she currently also serves as the board member of Goldman Sachs Bank USA, a trustee of Columbia University, a member of the board of overseers of Columbia Business School, the Museum of Arts and Design, the Economic Club of New York, and the Women's Forum. She is a member of Council on Foreign Relations. Ms. Kaplan holds a BA in government from Smith College and MBA from Columbia Business School. Ann, please.
Thank you. Is this working or do I? It is. Okay, good. Well, I'd first like to thank Glenn and his team for this incredible centennial celebration that they put together. It's amazing. And I can't resist, in the context of this celebration, pointing out that when the business school was founded 100 years ago, 13% of its first class were women. And does anyone in the audience know how many years after that Harvard admitted its first woman to the business school? 50. Exactly right. So you see, Columbia was ahead of the curve. I've spent my entire life in the my entire career in the financial services business, so I am going to focus on that. And technological change has always been an important part of that industry. When I think about when I graduated from Columbia in 1977 and went to Goldman Sachs, there were no PCs, there was no voicemail, there were no cell phones. So think of all the changes that have occurred in that time. The difference in what's going on now is the technological solutions that are being created are actually a challenge to the financial industry rather than being something they can incorporate to benefit them. And so this is another form of disintermediation, which I think we're going to hear about today across many industries, but it certainly has a lot of focus in the financial industry, especially in retail banking. And I don't know if anyone watched 60 Minutes last night, but this was one of the topics that they highlighted on 60 Minutes. So what's happening is that these digital solutions are creating new ways for us to borrow, to lend, to invest, to organize our personal financial lives. And they're doing it in ways that we no longer need to deal with traditional investment banks, and insurance companies. So obviously this is challenging for that industry. And McKinsey has just recently indicated that if nothing's done by the established industry to mitigate this, that by the year 2025, there will be an erosion of anywhere from 10% to 40% of their revenues on the retail side, at least. So you can imagine that the traditional organizations are thinking very long and hard about what they want to do, and they are buying some of these new entrants. They are creating their own digital platforms. They are investing in fintech as a way to make additional revenues. And it's very challenging for them to figure out when they've been doing business for, well over 100 years, and banking in its current form has existed for probably 1,000 years. It's very challenging to figure out how to address this new digital technological world that we're living in. So this has been one of the most radical and rapidly changing landscapes that I've experienced in my career. And how has it happened so quickly? Well, you need a supply side and you need a demand side. And on the supply side, there has been a significant decrease in the cost of technology and also in access to technology. And just as one example, in the dot-com era, if you wanted to start one of these companies, you would have to buy servers, you would have to hire sophisticated programmers. And just the other day, one of the young people in our organization, because we were frustrated with the way our current systems aggregate people's accounts, he created a new aggregation system using free online software and free tutorials. So the whole cost structure and the whole accessibility has changed. Number two, these new services are challenging for the establishment because with the widespread use of the internet and smartphones, physical locations are no longer necessary. And when you can do things digitally, the amount of labor you need is cut by a very, very large amount. The ability to access and mine big data and apply it creatively is another possibility that has changed the way we can think about who we lend to and how people borrow. And then the increased willingness of investors to invest in this area, something Fred knows a great deal about, is remarkable because in the past 5 years there has been about $25 billion of venture capital and equity capital put into fintech startups. And McKinsey had estimated just a year ago that there were 800 fintech startups, and they just estimated 1 year later there are now 2,000 fintech startups. So some of these are going to be successful and some of them aren't. We don't quite know, but it's absolutely clear that that landscape has changed forever. Now, what about the demand side? Some really interesting things are going on. First of all, there is an increased comfort level on the part of individuals in sharing personal information. I must say, I have been shocked. I never thought people would so willingly put all of their personal financial information as well as other organizational information online with companies that they really don't know much about. But that is what is happening. So a company that I invested in and was on the board of called LearnVest, which was recently sold to Northwest Mutual, is an online service where people would go on, they would aggregate all their accounts, their bank accounts, their brokerage accounts, and then the technology of the offering that this company had would allow them to create a budget for you, create a financial plan for you, and monitor in time frames whether you're adhering to it and whether you're, saving what you said you were going to save, etc. Consumers very much now want more transparency and control and user-friendly options, and that is why things like Prosper and LendingTree are so successful. And now you see the Goldman Sachs of the world starting digital savings platforms, digital lending platforms themselves. One of the most important things has been a lack of trust in the traditional banking industry. The crisis of '08 really shifted people's viewpoints on the financial industry, and they now want to have information themselves. They want to be empowered to make their own decisions. And this goes hand in hand with the populist movement that's sweeping not only our country but the entire world, where people are very anti-Wall Street, anti-big bank, anti-big government and establishment. So what you see coming out of that are all kinds of robo-advisors, Betterment, Personal Capital, Wealthfront, and then again you see established players like Schwab just came out with their own robo-advisor in order to compete with the startups. And then finally, we have an amazing desire for community right now in our society. I mean, exactly what is the basis of Uber and Airbnb is now transcending into the financial industry. You mentioned peer-to-peer. There are many online peer-to-peer companies that are springing up that allow investors to invest by sharing information with each other, sharing trade ideas with each other. There's a site which I would recommend you look at called Motif, which I think is a lot of fun. They give you the option of investing in different motifs like couch potato or lowering interest rates. Well, the most popular thing on their site are not all these motifs they invented, but it's the fact that the community, the users of the site can create their own motifs, and those are actually the most popular motifs. So it's very, very exciting. The landscape's changing, but there are also a number of unknowns. First of all, we don't know what the trade-off is going to be between this transparency, the availability of information, the ability to share with each other, and violation of confidentiality of information, as well as out-and-out misuse of information. We also don't frankly know what will be the result of a total lack of a personal relationship if things really get bad in the market, and whether people will stay with these digital solutions or not. Also, the digital solutions all use passive investment vehicles. They use ETFs. So we don't know in a very volatile market if things go awry and people swarm out of these digital solutions, will it affect the market? And then we also don't know whether the traditional wealth managers are going to be able to overcome their legacy positions and their way of doing business and take on these new technologies. And last but not least, these startups, which are unbundled part of the financial industry, are currently unregulated. And eventually the regulators will get to them. We don't know how long it'll take, and we don't know how agile the regulators will be in figuring out these digital platforms, but it will happen. And that will change the regulatory environment, and we also don't know how these new entrants will react. So lots of promise, lots of unknowns, but definitely a very exciting changing landscape.
Thank you, Anne. So next we will have Dr. Fred Hu, who is the founding partner of Primavera Capital Group, which is a leading China-based investment firm focusing on private equity and special situation opportunities. Now, in case you wonder what does the word Primavera mean, well, it is a plant in Central America, but it's more than that. It also represents the core values that Fred Hu's firm is subscribed to. So Fred, remind me if I miss anything. So it means partnership, reputation, integrity, meritocracy, aptitude, value, excellence, responsibility, and aspiration. That will be the acronym of the name of his firm. So previously, Dr. Hu was a partner at Goldman Sachs, where he was instrumental in building the firm's franchise in Greater China. He led some of the largest and most significant transactions in the firm's industry, including the ICBC, the largest bank in China, who went IPO a couple years ago. His current firm, Primavera, was a pre-IPO investor in Alibaba and also more recently in Xunlei. Both had successful IPOs in the US. Mr. Hu is a graduate of Tsinghua University in Beijing and holds Ph.D. in economics from Harvard. So he's going to talk about technological interruptions in both the investment advisory business as well as in portfolio firms that he has overseen. Thank you, Fred.
Thank you, Wei. First of all, happy centennial anniversary, Columbia Business School. I didn't have the fortune to be educated here, but I have the great fortune to be a friend of Columbia and the Columbia Business School. It's really an amazing institution, a center of global business education and research. The topic I'm going to comment in the next couple of minutes actually, and just really set the stage very well on this. There's really a widespread perception, the financial service industry is bloated, too big, overbanking. At the same time, a large segment of population complains they don't have access to financial services. Particularly, that's true for the low-income families. And a lot of small businesses also face significant hurdle raising capital. The problems of access, equity, and efficiency in finance are global in scope, but especially as acute in emerging world, including China. Taking China as an example, the country, on the one hand, boasts of some of the world's largest financial institutions, including ICBC, CCB, Bank of China. These are the giants, top 10 banks globally. But consumer financing, SME financing are still woefully underdeveloped. SMEs account for 70% of the job creation in the economy, but they receive less than 1/4 of the business loan outstanding. In fact, every one out of 5 small business, actually only 1 out of 5 small business has ever received a bank loan in the entire corporate history. Consumer lending is also minuscule in relation to the total domestic credit volume. In fact, I would say underdeveloped consumer finance and SME financing remains a key obstacle in China's transition from a heavy industry, export-led economy to a consumer-centric and service-based economy. So you might ask why the traditional banks and the non-bank financial institutions are not doing their job to provide the access, for the consumers and for small business. I guess it's not the unwillingness. It's really this particular customer base, like consumers, the risk profile, the cost, the information asymmetry, the lack of collateral, and the lack of credit history make it prohibitively expensive for traditional players, which is brick model institutions with large number of physical branch network to serve this customer profitably. So here comes with the innovators, disruptors of fintech I just talked about. So in China right now, it's a very dynamic scene of innovation with mobile internet, 700 million plus internet users. Many of them are actually mobile. So we have emerging fintech players like Ant Financial, Tencent. Actually, we have one of the co-founders of Tencent here in this room, Daniel Xu. But we also have JD, Baidu. Some of the names may be familiar to you. They are like search leaders or social media leaders or e-commerce leaders. But they are expanding into financial services. Why they have been able to do that? Well, mobile internet, provides the God-sent opportunity to overcome the problems that happen in traditional financial services in terms of scale, size, and cost effectiveness. But the big data has been able to plug the gap of information deficiency or information asymmetry. So more efficient credit scoring and credit pricing, and artificial intelligence. So this is very, very exciting emerging scene. Let me just use the Ant Financial. Actually, just a few days ago, last week, Ant Financial grabbed the global headlines by completing $4.5 billion in private financing, the biggest ever private financing round ever in history. Particularly right now, given all the concern about the valuation or the unicorns, and so that's obviously remarkable success. Ant Financial is a sister company of Alibaba. Its business strategy for financial services is very, very simple. It's really to use mobile internet, big data analytics, and artificial intelligence to provide affordable financial services to underserved population, low-income families, millennials, and small business. So this customer group is acutely sensitive to cost, as Anne pointed out earlier. They also care deeply about the experience, the digital distribution and delivery of financial products. So, like any other disruptors, these fintech players, including Ant Financial, are very ambitious. So they want to attack almost all fronts of financial services: payments, lending, wealth management, insurance, securities. My observation is that they have been actually successful across the board, but most notably in payments, lending, and wealth management. In payments, so Ant Financial has a payment service provider called Alipay. So some of you may have either used it or heard of it. So Alipay is kind of like PayPal equivalent of China, but it's 20 times as big as PayPal in terms of mobile transaction. It processes 106 million transactions daily. So that's actually bigger than MasterCard, trading only behind Visa. So it's already a very big, formidable payment company. And it has active user base of 450 million, which I'm going to give you some more big numbers, so it kind of mind-boggling. So Alipay is already now the world's largest online and mobile payment platform. on lending and financial has two killer applications. On the one hand, using mobile internet, they can efficiently gather savings in very small quantity, pull them together, right? So they can have very low cost funding and very low cost distribution, through online. So there's no, tens of thousands of physical branch network across the country. It's all done online. So that gives them a cost advantage. Second is the big data. So the SISMA credit service and the financial already covers 100 million users. So they track the income, household income, assets, the conventional financial metrics, but also track the social media data and their transactions on the e-commerce platform like Taobao and the Tmall. So all this gives them really significant amount of data. So they do actually much better job than traditional credit scoring methodology in terms of understanding the true risk profile. So they'll be able to do business. Otherwise, traditional banks cannot find it difficult to do. So right now, their customers they have lent to 50 million individuals. Many of them are millennials, like students and new entrants into labor force. They have never enjoyed they have never been able to access traditional lending from traditional banks. Now they actually fund 2.3 million small businesses. Again, none of them would have ever dreamed to get a loan from a traditional bank, but now they can access from the financial lending platform. Lastly, on top of the wealth management, it's kind of like a wealth fund in this country. So Financial launched a product called Real, actually in June 2013. Within 6 months, it became the largest money market fund in China. So almost like $80 billion, in money market. Mm-hmm. Now they have another product called Zhaocaibao. So the two products together, it's like over $100 billion wealth under management. So I think $4 billion under management by wealth fund, and maybe motif, right. Another $4 billion. That's my guess. So through mobile internet, big data, on wealth management, and financial now, has built AUM over $100 billion. Is all within 2 years. So it's quite remarkable. Now, and financial's impact and success is not limited just to China. It has now expanded into most of the Southeast Asian countries, as well as Korea, Japan, Russia, Australia, so I think it's really a very powerful case study how to use mobile internet, big data, and AI to provide affordable financial services to a very large base of population. So to make finance more relevant, more beneficial to the real economy, and bring much closer the goal of universal access to financial services more speedily, cheaply, and more efficiently. Thank you.
Thank you, Fred. So I want to add that Fred flew from Hong Kong and will go back tomorrow. So he's just in New York for a day for the centennial activity. So we're really grateful. So last we come to the healthcare industry, another place that is being dramatically reshaped by technological change. So I'd like to introduce you to Dr. Surya Mohapatra, currently executive in residence of Columbia Business School. He is the former chairman, president, and CEO of Quest Diagnostic Incorporated, the world's leading provider of diagnostic testing information services. So all of us interacted with his firm at least once a year, right after our annual checkup, oftentimes without our knowledge.
Have your blood.
So Surya is among a select group of Indian-born Fortune 500 chief executives. And he has been a strong advocate of patient empowerment and accountability to improve healthcare reduce cost. He holds a BS in electronic engineering from Regional Engineering College in India and a doctoral in medical physics from University of London. So when I first met Surya, I naturally asked about the healthcare industry, and he stopped me immediately. He said, "You are not talking about healthcare, you're talking about sick care, which is you seek care after you get sick." And he wants to make sure that he's going to talk about the real healthcare industry today.
Thank you, Wei. You know, if the last 20 years has been any indication of change, and one can guarantee that the next 20 or 25 years, that change is going to be intense, that change is going to be very rapid. We now see the change in technology, we now see the change in marketplace, we see the change in also the customer demands. We also see the changes in the employees who come to work for us. So there are a lot of changes going to go on as we move forward. I believe that the next 25 to 30 years is probably the most exciting years in healthcare because it has a lot of opportunities globally, but also it will bring some uncommon challenges. So whether you are a new general manager or whether you are a veteran CEO, one thing I have come to the conclusion that you have to learn how to think the unthinkable. And also you have to adapt to the new rules of the game. So today I'm going to talk a little bit about healthcare, and also want to talk about two main factors which may have significant impact in the way the healthcare industry is going to grow. It has been a growth industry, and it is positioned for rapid global growth. But I don't know whether the current players can really take advantage of the potential which is ahead of them. So let's think about the two factors which I want to talk about was the demographic shift and how that is changing the market, how that is actually taking the business to different place, and also how convergence happened. And you know, people talk about technology, but I am a strong believer that technology on its own is not solving the problem. It's the convergence of technology with the application and the customers and the market gap. That's really creating new businesses. So let's talk about a little bit about demographics. You know, there are 7 billion people in the world, and almost 60 to 70% of the younger generation, maybe I should say about the MTV generation, as in Asia Pacific. And basically it's in India and China. Then you have India, where 1.2 billion people, for 65% of the population is below 35 years of age. Then you talk about US, there were 325 million people, but every day in the US, there are 10,000 people are becoming 65-year-old. So the US market is aging. The need for medical care is different than the medical care that is required in India and China. Let's talk a little bit also about the newborns. 75 million newborns in the world. There are only 4 million new births in the US. There are 17 in China and there are 24 in India. So if I as a business person look at, I said, okay, what services and what products I'm going to provide, and if I intend to stay in this business for the next 25 or 30 years, what is my business? I have to change the products and I have to change the services to meet the aging requirement in the US, which I'll talk a little bit more about, but also I have to meet the requirement of these emerging countries, basically Asia Pacific and basically the young generation. India has 400 million middle class. They have higher earning capacity. Now they are looking for quality health care. But India doesn't have it. So the question is, who are the global players who are going to provide that kind of services to India and China? And are the players going to come from India or China, or it's going to go from US? Now, all these things really poses tough questions, not only the people who are graduating from Columbia Business School or any business school, if they want to go to healthcare, but also the veteran CEOs. How do we really change the company's DNA to meet what is happening in a global market. It's already difficult to actually manage a West Coast company if you are based in East Coast. A lot of us have international operations, but visiting China and India and Australia ceremonially is not going to give you the market hold which you want. So my suggestion to the upcoming leaders and the current leaders is actually to find out what is really required and how do you really be cost competitive. For example, medical devices. There is higher quality, lower cost products coming from China and India to compete in the US marketplace. Pharmaceutical industry have done miracle drugs, but the price is such that the various countries' regulators are putting limit. So the pharmaceutical company has to find out a way how to be globally competitive. So the current business and the current business leaders have to understand what is the rules of the game in different parts of the country. Let me talk a little bit about technology and convergence. There is no doubt that there have been miracle drugs. Pharmaceuticals have really progressed a lot. It has increased our longevity. It has cured diseases. There is no doubt that the medical devices, whether it is stent or whether it's pacemaker, has reduced morbidity and mortality, and there have been a lot of advances. But here is my issue, and the reason why I told Wei that healthcare in the Western country has nothing to do with healthcare. It's everything to do with sick care. And frankly, it is sick procedures. If you go to a doctor and his doctor said, Surya, you don't need any medicine, he cannot bill you. If you just still go home and take some rest, that time is lost. So the incentives are misaligned. But when you come to the healthcare delivery systems, it has not taken the great discoveries that has happened in biomedicine, in the research area, or the great products and devices, because the healthcare delivery systems, to me, stuck in an analog world. You know, it looks like the healthcare system prefers to use their rotary dial telephones, while other industries are talking about Skype, FaceTime, and Facebook. But look at the convergence that has happened. Many, many years ago, you must have seen that in many of your offices, you had a fax machine, you had a scanner, and then you had a copier. You don't see that anymore. OK Data changed that. You have one system which can do fax, copy, and scan. You have saw the telephones. You know, now in India, there is 500,000 cell phones are being sold every month. And I remember using the cell phone, which is the flip phone, which was just a phone. Then somebody introduced how to take a picture. Then somebody introduced how to read your email. Then came Android and iPhone. And now this little computer has more, or this little iPhone has more computing power than the computer I used 30 years ago to do my Ph.D. But this is the sign of the convergence, where it is no longer a phone anymore. It's a camera, it's a browser, it's a email. But that kind of convergence is ready to happen in healthcare. It's ready to happen really to really move from healthcare, from sick care to true healthcare. Let me give you an example. When it comes to digitization of medical records, you know, we think EMR is an innovation, but frankly, EMR is not an innovation. If you call email is an innovation, then EMR is an innovation. Digitization of medical record, whether it's diagnostics or whether it is imaging or whether it is surgery, and then connected to the various systems and using, as Fred was talking about, big data or predictive analytics, which is pretty common in other industry, is really not done in the healthcare delivery system. So healthcare is far, far behind in those kind of systems. Let's talk about the other convergence of various systems that's happening, like biosensors, nanotechnology, Internet of Things, or big data. Those are the things that's really going to change the way the healthcare is practiced. Finally, when the cognitive computing like IBM Watson or the robotic surgery like Da Vinci joined with the pharmaceuticals who have targeted therapy and companion diagnostics, it will really open up different way medicine is practiced. It is completely going to transform medicine. And I believe the 21st century is going to be the era of precision medicine. Thank you.
Thank you, Surya. So for the sake of time, we will open up the questions to the floor. So when you raise a question, please be clear to which panelist or panelists you would like to direct the question. Any microphone? You can. I think the microphone is coming here.
Two questions. The first one is to the gentleman from Viacom. One of the critical issues that seems to be a problem that can be transported globally is humor, and I'm wondering if you might address that. The other one is to all the panelists, and it refers to the hidden factor in all this, which was alluded to. It's regulation, it's government oversight, it's laws, and equally important, administrative obstacles. How are these not only going to slow down what we've talked about in terms of all these convergences, but what is it going to mean in terms of having those forces be strong enough to, in effect, overcome such demands, especially on the elites of countries who run them, and very much like having the power that they have?
So real quick on the comedy point. So one of the brands we operate is a brand called Comedy Central. You might know it in the U.S. And the common wisdom is comedy doesn't travel. That doesn't mesh well with the fact that Comedy Central is in about 250 million homes worldwide. And the reality is comedy does travel in the form of scripted comedies, travel very well. So you could think of those as, like Cheers and the like, shows that would be on network television. In addition, formats work very well. So we do a lot with formats. The easiest format to do in comedy is stand-up comedy. There's actually vibrant stand-up comedy in most countries. You have to be careful with culture and not to insult people, because insulting people to some degree is okay, but if you go over the line, then you got a problem. But many elements of comedy do travel. Again, you have to be sensitive to local. It's why we believe in something called global, part global, part local, and it's why you have teams on the ground. But people all around the world like to laugh. In fact, I saw a study, 2 years ago, which talked about religion versus humor, and people in general valued humor more than religion in some of these studies. So comedy does travel.
Is this working? Okay, you brought up a lot of things, but I just want to touch on one of them briefly, and that is what's going to happen to the workforce. Because as things become more and more automated through these technological solutions, there will be fewer and fewer jobs. And some jobs are being created in the sense of all the regulatory morass that you mentioned, because compliance jobs are premium. If you want a job right now, go into compliance. And the other thing is cybersecurity is a huge creator of jobs, but on balance, jobs are going to be eliminated. So I think over the next 100 years, one of the things we're going to have to come to terms with, and Glenn mentioned this earlier, is what is work going to be defined as, and how long is a work week going to be, and what other, especially with living longer, how are we going to define the span of our lives and the activities we engage in?
No, I think this is working probably. Yeah. Whenever there is a new technology, I think it is the industry's responsibility to educate the regulators. I was involved in the early stage of introducing MRI to the marketplace, and we educated FDA. So when you talk about new things that is happening in healthcare, when technologies, regulation is sometimes really good, because it is not like other industries, not like IT or write an app, that if you fail, it's okay. But in healthcare, if you make a mistake, you are dealing with somebody's life. So I'm a strong supporter of actually educating the regulators ahead of time, working with them, not only just for the introduction of the product, but also actually getting the reimbursement and getting the approval, and actually making sure that it is done the right way.
So we'll have time for one last question for the panel. Do you have any? Okay. Okay, if not, let's give a round of applause for our panelists. Thank you.